Receivable finance includes 6 main topics. 1. Financing receivables, understanding its context. 2. Types of receivables financing. 3. Benefits of receivables financing. 4. Foundational concepts. 5. Evolution in receivables finance. 6. Risks of receivables financing. 7. Risk mitigation options. Receivable finance refers to a set of financial solutions that allow businesses to access cash tied up in outstanding, unpaid invoices, accounts receivables, before their maturity date. It is a strategic short-term funding method that improves cash flow and working capital by converting credit sales into immediate liquidity, enabling companies to pay suppliers, fund operations, and invest in growth. Core context and functions. 1. The problem. Sellers of goods or services often face 30 to 90 plus day payment terms from buyers, causing cash flow gaps. 2. The solution. Sellers sell or pledge these invoices to a third-party financier factor at discount to receive immediate cash. 3. Key parties in receivable finance. The seller creditor, debtor buyer, and the factor finance provider. 4. Risk mitigation. It helps manage credit risk, particularly when using non-recourse arrangements where the factor assumes the risk of debtor default. Key types of receivable finance. 1. Factoring. Invoice factoring. A business sells its accounts receivable invoices to a factor, a third-party financial company, at a discount. The factor takes over the responsibility for collecting payments, which reduces the administrative burden on the business. 2 types of invoice factoring. 1. Recourse versus non-recourse. In recourse factoring, the business must buy back unpaid invoices, while in non-recourse factoring, the factor assumes the risk of customers' non-payment. 2. Notification versus non-notification. In a notification deal, the customer is informed that their payment should be made to the factor. 1. Invoice discounting. The business retains control over its sales ledger and collections, while lender advances funds based on the total value of the invoices. This is often confidential, meaning customers are unaware of the arrangement. 2. Asset-based lending, ABL. A broader form of financing where a company uses its receivables and other assets like inventory or machinery as collateral for a revolving line of credit. It is frequently used by larger businesses with high volumes of receivables. 4. Supply chain finance. Reverse factoring. A solution where a buyer works with a financial institution to pay their suppliers early, allowing the buyer to extend their payment terms while the supplier gets immediate cash. 5. Spot factoring, spot deals. A single invoice or a specific one-off transaction is sold to a factor rather than an ongoing agreement, offering more flexibility. Key benefits of receivable financing include 1. Immediate cash injection. Converts B2B invoices into cash, eliminating the 30 to 120 day wait for customer payment. 2. Improves cash flow and working capital. Provides consistent, predictable cash flow to manage daily expenses, seasonal demands, or sudden growth opportunities. 3. No debt accumulation. Unlike loans, this is the sale of assets, invoices, meaning no new debt appears on the balance sheet. 5. Easier approval requirements. Approval is based on the creditworthiness of customers, not the borrowing business, making it ideal for startups or businesses with poor credit. 6. Reduced administrative burden. Factors often manage the collection process, allowing businesses to focus on core operations. 7. Risk mitigation. In non-recorded agreements, the factor assumes the risk of customer non-payment. One. Core definitions of foundational concepts. Account receivable AR. Money out to a business by customers for goods or services delivered on credit. These are recorded as current assets on the balance sheet. Receivable finance, a method to convert outstanding invoices into immediate cash, usually 70% or 90% of the invoice value, before they are paid by the customer. The debtors, the customers who owe the money to a business. 2. Key components and mechanisms. 1. Advance rate, the percentage of the invoice value that the financer advances upfront, typically 70% to 90%. 2. Discount fee, factor fee, the cost of the service, usually a percentage of the invoice amount charged by the lender. 3. Recourse versus non-recourse. Recourse factoring, the business remains responsible for the debt if the customer fails to pay. Non-recourse factoring, the factor assumes the risk of the customer not paying. 3. Important metrics. 1. Days sales outstanding DSO, measures the average number of days it takes for a company to collect payment after sale. 2. Receivables turnover ratio, measures how efficiently a company collects its receivables with a higher ratio indicating faster collections. 3. Aging schedule, a report that categorizes unpaid invoices by how long they have been outstanding, for example, 0 to 30 days, 31 to 60 days, to identify potential bad debt. Key aspects of the evolution in receivable finance. 1. Technology and digital transformation. The industry has moved from manual ledger cards to cloud-based platforms utilizing AI for predictive analytics, forecasting payment behaviors, and enabling faster, secure payments. 2. Shift from traditional factoring. While once niche, invoice finance is now a mainstream liquidity tool, with lenders increasingly targeting the SME sector for growth, bringing new risk management considerations. 3. Embedded finance and integration. Receivable finance is becoming integrated directly into ERP systems, allowing for smoother, automated, and more efficient non-bank capital participation. 4. Enhanced risk management. With the rise of digital tools, risk management has evolved to include better data-driven insights. 5. Speed and convenience. The trend is toward instant, faster payments and mobile check capture, which streamlines cash application and reduces days sales outstanding DSO. Key risks of receivable financing. 1. High costs and fees. Receivable financing involves discount fees, which can reduce profit margins, significantly more than traditional bank loans. 2. Customer relationship strain. If the factor finance company contacts clients directly for payment, it may create confusion or give the impression that the business is struggling financially, which can damage long-term relationship. 3. Recourse liability. In many arrangements, the business remains liable for invoices that are not paid or are disputed by the customer, meaning that the business must repay the advance. 4. Credit risk and default. If a customer defaults, the financing company may charge back the invoice, resulting in unexpected losses. 5. Operational control and complexity. Businesses lose control over the collection process and may face extra administrative burdens in managing the financing, including potential issues with hidden over-invoicing or fraudulent invoices. 6. Contractual constraints. Some agreements involve long-term contracts, making it difficult to exit the arrangement if cash flow improves. Key strategies for risk mitigation in receivable finance. 1. Trade credit insurance. Protects against non-payment, insolvency, or protracted default, guaranteeing payment for goods or services sold. 2. Factoring. Involves selling accounts receivable to a third-party financial institution, which provides immediate cash and often assumes risk of collection. 3. Credit risk analysis and monitoring. Conducting through regular credit checks on customers, utilizing credit management software to automate and reducing credit limits for high-risk accounts. 4. Establishing strong credit policies. Defining clear, enforceable payment terms and ensuring through vetting before extending credit to new clients. 5. Diversification and concentration limits. Reducing dependence on a few large clients by spreading sales across different industries or geographies, lowering the impact of a single client default. 6. Proactive collection and cash application. Implementing streamlined automated invoice-to-cash processes to reduce days sales outstanding (DSO) and identifying potential payment delays early. 7. Establishing reserves. Creating an allowance for doubtful accounts to financially buffer the company against potential bad debts.